And Sonu, let's see here. Maybe before we go to that part, again, we could talk about this all day because we do, so we need to make it fairly quick. What does it mean for the Fed? What does that mean for the Fed if inflation is no longer a problem?
They can cut. That means they've raised rates all the way from 0% to 5.5%. Why? To fight
Yep.
inflation. But they did that thinking, oh, inflation's running at 3, 4, 5%. I mean, obviously last year it was running even much higher than that. But they say, okay, if inflation's running at 4, 4.5%, yes, maybe you need interest rates at 5.5.
Yeah.
Well, if inflation's running 2, 2.5%, you don't need rates at 5.5%. You can cut, right? And I think that's what markets are looking for. I know that's what we are looking for. We've been saying that. We just didn't think they would cut in 2023. We thought that would be a 2024 story. I think markets have caught up to that. Maybe markets are getting a little ahead of themselves, but I think our base case is there's not going to be a recession in 2024, so they don't have to cut a lot. But we still think maybe they'll cut 3 to 4 times, maybe by 1% or so.
Yeah, I think they call it as a surgical cut is the lingo that they use. But the bottom line for everybody listening, inflation was a headwind. The Fed hiking was a headwind. It really hurt stock prices as we saw, in 2022. It really hurt bond prices. Keep it real simple. When rates go up, bond prices tend to go down. Well, you know what's happened all of a sudden with the expectation the Fed's going to start to cut and inflation not a problem? Bonds have started to come back and do a little bit better for those of you with a lot of fixed income exposure. So again, those are just some real positives as we move forward. Some other real positives here. I'll take this one, Sonu. Strong incomes equal strong consumption. I mean, keep it real simple. The consumer makes up like 2/3 of the economy. The consumer is still spending. And what's really, really important when you look at, incomes relative to inflation and things like that, they're still hitting all-time highs. Wages are hitting all-time highs. Yes, prices cost more, or I shouldn't say that. Things cost more is what I'm trying to say. Prices cost more, whatever that means. Things cost more. But the good news, again, a lot of people are actually increasing their wages and their compensation more than inflation. So we have all-time highs. And again, if the consumer is still strong, which they are, and you're still having an economy that's creating 200,000 jobs a month, we're still optimistic the consumer will be a strength into next year. Oh, we did have actually, okay, so I cheated a little bit. We do have a chart about the Fed here. Talk to me about this one, Sonu, about the Fed. We kind of already talked about it, to be honest. But anything else you want to point out here about the Fed and cuts here?
I think it gets to that inflation story, and we are in a really nice place with respect to all this, right? Going back to connecting all the slides to this one, is that we're seeing inflation low, but the labor market employment is still strong. That means incomes are growing, inflation-adjusted incomes are growing. That's positive for consumption, which means what? It's positive for the economy. It's positive for stocks because that's where profits come from. Profits come from the economy, right? People, you and I spending, companies getting more revenue, sales, things like that, right? But as far as the Fed is concerned, they're looking at inflation. They think, you know what? The labor market is strong, but it's not too hot. But inflation's coming down close to a target. So we don't, like I said, you don't need to keep rates at 5.5%. Markets think investors right now are pricing about 4 to 5 cuts, each worth about 0.25%. That's the 25 basis points that you see there. But Ryan, the big thing is long-term interest rate expectations also pulling back. That's really important when you think about the 10-year interest rate, right? That's priced off. What do we think? What do markets think Fed policy rates will be in the future, right? That's basically what long-term interest rates are, right? What will short-term rates be in the future? It's as simple as that. Few months ago, markets are, those short-term rates in 2027, for example, on the right side, would be above 4.5%. That's come down to 3.7%. As that comes down, what does that do? Mortgage rates go down, credit card rates go down, all of that. That's a boost for the economy as we get into next year.
No, exactly. I mean, we see it. You see it, right? When you drive around, are there a ton of houses for sale in your neighborhood? Probably not. A lot of people are locked in at higher rates. They'd rather not move. And with mortgage rates up 7-8%, people are a little skeptical of moving across the street, so to speak, unless they really have to, because you're going to be paying a lot more. Now the door is opening, right? The Fed can start cutting. These mortgage rates are starting to pull back. And mortgage rates pull back a good deal next year. That could unlock, is probably the phrase we like to use, unlock a lot of activity in the economy that honestly housing's been a drag for a couple of years now. Clearly with higher rates, people haven't been moving as much. But that could unlock a lot. So we've got about 5 minutes or so to go here. I mean, Soto, I want to talk about these are some of your biggest surprises of the year. You want to talk about these quickly?
Yeah, the one on the right is the chart of the year, right? So what have we talked about? We basically talked about the consumer strong because the labor market is strong. So that sort of provides that solid foundation for the economy. Now, what's been the drag over the last couple of years? It's been the Fed, high interest rates, right? High interest rates affect housing, as you said. It affects cyclical sectors of the economy like manufacturing. Now let's take housing, just to put that out of the way. Housing, obviously, like you said, nobody want if I have 3% mortgage, if I have to move, I'm going to think twice about it. In fact, I'm going to think I'm not going to move because I don't want to pay an 8%.
You're gonna think more than twice about it.
Yes.
Yeah.
I think I have thought about it. I said, no, I'm not going to move.
Or maybe you only think once about it and say, no, I'm not going anywhere. Maybe you only think once about it. That's the way to look at
right.
it. Yeah.
Unless you have to, right? And but here's the thing, despite that, Ryan, this is incredible, right? On the left-hand side chart, that shows the number of single-family homes and multifamily homes under construction in the United States right now.
Yeah.
That is running close to 50% above what we saw in 2019. That's incredible considering interest rates are at 5.5%. Construction is booming. That's on the residential side. Let's go to the non-residential side, right? We are seeing something. I mean, this is my chart saying America is back, right? Over the last 2 decades, what do we see? Manufacturing went outside the U.S. I know manufacturing is not a big part of the economy, but still it matters because these are high-wage jobs, things like that, right? It's important for a lot of different pockets of, the country. Last 2 decades, we saw globalization. We saw, countries going out. I think all that sort of came to bite us back. I was going to use a different term, but I won't. After the pandemic, it says supply chains are stretched and we got inflation. These supply chains are not very robust. So we have reshoring and nearshoring and all of that. Factories are coming back. And what we've seen over the last year, really, we started talking about this in March, we are seeing a massive boom in factory construction here in the US. That's what you see on the right. Manufacturing construction of basically factories is, after adjusting for inflation, is up 100% since the end of 2020. So 3 years, 21, 22, 23, well, through October. Factory construction is up 100%. What's driving that? Semiconductor plants, electric vehicle battery plants, things like that. There's so much of that going on, factory construction. That stuff, Ryan, bottom panel of the right chart, up 900%. 900%. This looks like a stock market chart. It doesn't look like anything I've ever seen in economic data.
No, great points there. Again, a lot of that is fiscal policy, what the government's doing, the CHIPS Act and certain things. But again, what we realized, we didn't like not being able to get our chips because we're getting them from China, different places, because they're on lockdown, they're on shutdown, and we weren't. So we said, hey, let's bring it back. So I don't think people say, oh, the government's behind it. Listen, sometimes the government can do some good things. I think with some of the policies that they've implemented, you're seeing it here. What's going to happen now? We're building these things now. Think about the productivity and the gains and the growth that can come once these factories and places are actually built, and then the gains come down the road. So we've got a couple minutes here, which is a nice lead in, honestly, to creating higher productivity. So I'll turn it to you in a second here. One of the knocks on our country has been we haven't had high productivity for a while. You can see it here. There's been periods where it's grown okay. Honestly, historically, usually you have higher productivity when in a recession. Why is that? Because everyone around you just lost their job. So you're working 3 times as hard. So you better be more productive because everyone around you doesn't have a job anymore. So you have to be, right? You have to be more productive. The good news, the last 2 quarters, as this economy is growing, we have AI, we have a lot of other excitement and things that are taking place out there. We're seeing higher productivity. So talk to us, and again, we probably could talk an hour on this one also. Why does productivity matter, and why is higher productivity next year one of the things we think could be a surprise to the upside?
Productivity basically just put it simply, it allows workers to earn more while inflation remains low. Right?
There you go.
So what we saw in the 70s was productivity is really low. But wage growth was actually running high. All that just translated to inflation.
I blame disco for that, actually. I think a lot of people blame disco for that in the 70s, but nonetheless. Yeah.
And we actually saw that after the pandemic too, for between 2022 especially, right? Productivity went down because it initially went up, to your point, right?
Initially.
Yeah, because we were producing the same amount of output, GDP. It came back by 2021 from where we were in 2019 with 8 million fewer workers. Everyone's more productive, but people started hiring them back, right? Suddenly productivity this is all artificial productivity. It's not real productivity, right? And so it came back down in 2022, but now what are we seeing? We're seeing more business investment. That's crucial because you need businesses to invest, right? When do businesses invest? If labor is not cheap. Going back to what we saw the last 2 decades with globalization, all of that, labor is cheap. Companies didn't have to invest. We are in a different environment, we think, right now. Labor is more expensive. You have to pay workers more. So businesses invest in new technologies, things like that. That feeds into more economic growth, and most importantly, economic growth without inflation or with relatively low inflation. I'm not saying zero inflation, right? That
Right.
allows the Federal Reserve to keep policy a little looser. It means they don't have to keep rates at 5.5. Maybe they lower it to 4%.
I'll just chime in, and we like to look at history, right, on the Carson Investment Research Team. 1994, the Fed hiked rates aggressively. Bonds had one of their worst years ever up to that point. The stock market didn't do all that well either. You know what happened? High productivity. There are videos of Alan Greenspan. You can find them talking about the higher productivity that was out there. The higher productivity we started to see in the mid to late 90s opened the door for Greenspan to actually cut rates, because he hiked a lot in 94, and then he did a few surgical cuts in 95. The economy avoided a recession. Productivity was strong. Wages were strong. Inflation under control. Oh, and by the way, for those who remember your history books, mid to late 90s was a really good time for investors. So again, no two times are exactly the same, but we see some major similarities now with then.
The late 90s is a good time for music. Like I was talking about Europop. No, I won't have it.
There you go. Good time for Sonu's music also. So there you go. But the bottom line, again, productivity is such a game changer, and it's so important. It's something we're going to watch very, very closely here on our team. And we think higher productivity could be a game changer into the next several years. I've got two final things to remember, and then we'll do some final comments and wrap things up here. Just for the average investor to remember, things to remember. Remember, I did the one earlier. Now we're going to do two more. The longer your holding period, the more likely you are to have gains. You mentioned coin flip. I heard that earlier. The average day is up about a coin flip. You can see, what is it, 53% of the time. But we call this the Joe Montana. Our friends at Bespoke call this the Joe Montana rule. Remember what number Joe Montana was? 16. Every 16-year period, stocks have been higher. No matter when you buy, you're higher 16 years later. Now, trust me, nobody really wants to buy and have to wait 16 years to make money. The good news is when stocks sell off and when they've been lower, these returns get even better. But any one random time you buy, you hold 10 years, you see up 90% of the time. 120 years, 25 years later, stocks have never been lower. So I think it's really important for investors when the screen is scary, when there's red out there, when the person on TV told you this bad thing's going to happen, and it might happen, okay? But a long enough time horizon, there's one of the best ways to create wealth, to beat inflation is in the stock market. We still feel that way. We felt that way for a long time. We haven't changed. But again, it's just important to remember the longer you're invested in something, the more likely you are to have some gains. Final thing, volatility happens. It is what it is. We're creatures of habit. When things get scary, we want to hunker down. We want to sell. We want to get out. You know who you are. October 22. Someone on this call might be listening. You might have sold in October 22 because everything was scary. It was, and it is what it is. But just remember this. Markets tend to come back like we talked about earlier. But also, your average year sees 3 separate 5% mild corrections. You see 7 different 3% mild pullbacks or mild dips every single year. We had a 10% correction this year into this October low. It was pretty scary. It was pretty uncomfortable for a lot of people. But that tends to happen. So on average, every year sees about, well, not every year sees one, but it's on average, you're going to see a 10% pullback every year. Now, again, some years don't have any. Some years have 2 or 3. That's how you get to the average. Let's be clear. But again, volatility happens, and you see a bear market about every 3 years, approximately on average. Those are some very important things to remember. All right, Sonu, I think we're at the, we are officially at the end. We did pretty good. You and I are long-winded. We're not too far over 30 minutes. Any final comments for the listeners? I'll bring us home.
Look, I think I go back to your chart showing average is not average. Mm-hmm. Normally, on average, you expect about 9% return for stocks, but that doesn't happen, right? More often than not, you get something much better or much worse. Well, right now, the good news is the odds are in favor for something much better because the economy is not in recession and consumers are in good shape. If the Fed lowers interest rates, that could boost cyclical sectors. So if the economy is strong, that's where profits come from. Profits are likely to go up. That puts the odds in favor for a better than average year.
Well said there. I'll go a different route. We know there's a lot of information out there. We know there's a lot of scary headlines that are out there. We're just honored and delighted that you took some time to listen to Sonu and myself and really our entire team's views on how we saw the world last year, how we see the world into next year. Continue to work with your financial advisor to make sure you listen and pay attention. And sometimes, our brains are wonderful things, but we want to make the worst decision at the worst possible time. It's not your fault. It's not anybody's fault. It's how we are wired. So again, if you listen to this, you have a financial advisor, you're in very, very good hands. Continue to pay attention to what they're telling you. And if you want, continue to listen to our team and what we're seeing out there, because we're not always going to be right. We're not always going to be wrong. Hopefully we're right more often than we're wrong. I want to be clear there. But we are going to be honest, and we're always going to be forthright. We're always going to be upfront of what we're seeing day after day, week after week, month after month. We're going to be there for you. So with all of that, everybody, have a great end to 2023. And here's to a very, productive, like the way I did that. We talk about productivity, wealthy, but more importantly, healthy 2024 from everyone at the Carson Investor Research Team and Carson Group. Take care. Thank you.
Thank you.